let's start. What is our requirement in this question? It's quite a long one. Required is to calculate the weighted average capitalization rate applicable to MSL PLC's general borrowings for the year ended 31st December 2025. We'll talk about that. Weighted average rate is needed when you have a pool of loans, right? Apart from having specific funds. For a pool of funds available, you need to find a weighted average capitalization rate, and we'll do that. The B part is to calculate the total borrowing costs eligible for capitalization for the hydroelectric power plant for year ended December 25. Your calculation must clearly distinguish between the specific and the general borrowings and account for the suspension of activities. The C part is to calculate the total carrying amount of the hydroelectric power plants, that is the asset under construction, to be reported on the SFP as at December 25 year end. That's it, right? Let's go through the question. And so this is how you should read questions on an exam day. Take the requirements, see what you're being asked to do. Then when you're reading the question, you do so with clarity. You know exactly what the examiner wants from you, right? So MSL PLC is a publicly listed energy company. They prepare their financial statements to 31st December each year. So at least we know their year end. Year end is 31st December each year. On 1st January 2025, directors made the decision to construct a new hydroelectric power plant, okay? Due to the scale and complexity of the project, it meets the definition of a qualifying asset under IAS 23. So under IAS 23, a qualifying asset is one that takes a substantial period of time to get ready for its intended use or sale, right? And for such qualifying assets, eligible borrowing costs can be capitalized as part of the cost of those assets. Now, to give you a broad overview, the standard permits your net borrowing cost to be capitalized, which will be your gross borrowing cost less any investment income from the temporary investment of surplus or unused funds, right? Then if there's any suspension of activities, you don't capitalize borrowing costs during that period. This is a little summary, right? Hopefully, you have gone through a course that has taught you the principles. So this is a revision question. So construction activity and the physical preparation of the site commenced on 1st February. So take note. They decided on 1st January to do the construction, but it wasn't until 1st of February when the directors decided that they were going to do the construction. So construction, physical preparation started on 1st February. Very important date, right? On that same date, which is the same 1st February, MSL PLC secured a specific bank loan of 20 million to assist in financing the project. Now, in IAS 23, you come across specific borrowings and general borrowings. A specific borrowing is one that was specifically taken to finance the project. Okay, so for that, you use the given interest rate on that loan. So we are told that the specific loan carries a fixed interest rate of 6% per annum. So we would use 6% for the 20 million Ghana cedi loan. The proceeds from this loan were temporarily invested in a money market account, earning 4% per annum until they were required for payments to contractors. So remember, anytime we realize there is a surplus, money that is not being used, surplus funds available, idle funds available, surplus or idle, right, would invest the surplus or idle funds to earn 4% interest, okay? The construction schedule and payments made to the contractors during the year were as follows. On 1st of February, the first progress payment was made, and it was 8 million cedis. Do not forget, you went for a loan of 20 million. So if you spend 8 million here, then you have 12 million left from the 20 million loan. Okay, we'll come to that. Don't worry. 1st September 2025, they paid the second progress payment. They paid 16 million. So clearly, this total cannot be financed by the 20 million. This is where the general pool of loans would come in. Because if you think about it from this perspective, you've paid an amount of 8 million. You've paid an amount of 16 million here and here. When you add this to, they spent an amount of 24 million, but they went for a loan of 20 million here. So there will be a what? There will be the need to go and source for extra financing. That is when we look at the general pool of loans. So take note of that. I'll come to that. Construction proceeded as planned until November. From 1st November 25 to 30th November 25, all construction work at the site ceased. Okay. Remember, when there is a temporary cessation of construction, capitalization of borrowing costs must also cease. But let's see why there was a suspension. The suspension was caused by two distinct events. The first 2 weeks, that is from 1st to 14th November, were lost due to a scheduled environmental impact review required by local legislation at that specific stage of construction. This is a required break. For required breaks or required suspensions, please, they are necessary. And because of that, you don't suspend capitalization. This first 2 weeks is a scheduled, you are told it's a scheduled environmental impact review. It's required by law that you pause for 2 weeks. So this one, you cannot say you suspend capitalization of borrowing costs because of this. Yes, they stop construction, but it's a necessary activity. You usually cease or suspend capitalization for abnormal events. So watch this one. The final 2 weeks, 15 to 30 November, were lost due to an unexpected strike by the construction workers union. Maybe they were not being paid well, and they said we're going to stop working. In those 2 periods, yes, we will suspend what? Capitalization of borrowing costs. So take note, it's not every suspension of activities or construction that leads to suspension of borrowing cost capitalization. Necessary and normal activities, you don't suspend capitalization. Example, the question said maybe they had to wait for the concrete for the construction to dry. Waiting for concrete to dry before you continue is a necessary activity. It's needed for the construction to continue. You can't say because of that, you are going to what? Suspend capitalization. So let's take note of that, okay? So always check the kind of suspension you're given in the question to be sure if it's one that requires you to actually suspend or it's an activity that was needed. It had to be done. For those ones, you don't suspend. But those surprise actions like a strike, like a flood, like an earthquake, those are unexpected. Those are not part of the construction process. And you suspend capitalization for those periods. Work resumed fully on 1st December 25, and the asset remained incomplete at year end. Incomplete at year end means that you still have an asset under construction by year end. So you cannot say you are stopping capitalization. But at year end, which is what we are being asked to do, we'll do a cutoff and find what must be done in the books as at that point. But remember, you continue from 1st January 26 because construction was still ongoing at year end. Okay. MSL PLC finances its operations through a pool of general borrowings in addition to specific project finance. When the specific loan proceeds were exhausted, we saw that they spent 24 million in the project. They had a loan specifically of 20 million here. You see? So when the loan proceeds were exhausted, MSL PLC utilized funds from its general debt pool to finance the remaining construction costs. The details of the general borrowings, which were outstanding for the entire year ended December 25, are provided below. So we have this pool of loans. Bank loan A, 15 million CDs at 8%. Bank loan B, 10 million Ghana CDs at 10% interest. Then redeemable note of 5 million Ghana CDs at 9% interest. Here we need to find the weighted average capitalization rate, WACR, right? Because whenever I have a pool of loans or a pool of general finance, you do not have a specific rate. It's different amounts at different rates. We need to find the weighted average rate to use for capitalization, right? So finance director has asked you for a calculation of the borrowing cost to be capitalized. He's unsure how to treat the period of suspension and whether the investment income from the temporary investment of the specific loan should be netted off against the borrowing cost or recognized as separate income. He's not sure. So you've been called upon to do this. Find the weighted average capitalization rate, number 1. Number 2 is total borrowing cost to be capitalized. And number 3, the carrying amount of the asset at year end. Remember, it's an asset under construction. So we would treat it as such. So that's about it really for this question. This is a standard borrowing cost question. If you can do this and practice some more, you should be able to attempt any other question. So let's start with the first part, which is to do the weighted average. Remember, we're going to use this table right here to do the calculation. Okay. So we're going to open a new worksheet and proceed. All right. So all right, so let's do the first part here, which is our weighted average. So we are finding our weighted average capitalization rate. It's a very easy thing to do. Just create a table. In fact, to make your life easy, you can actually replicate the table they give you in the question, if it's in a tabular format, that is, and then find the annual interest and then weight it based on the principal amount. So this is what I mean. So let's write out. We have bank loan A 15 at 8, bank loan B 10 at 10, and then redeemable note 5 at 9, right? Let's do that here. So I'll create a table here. So I have my bank loan A, bank loan B, and my redeemable note. So for the bank loan A, my principal or my loan amount, they said it was 15 million. Second was 10 million. And third was 5 million, right? We are picking everything from here, this table. Interest rate 8, 10, 9. So 8%, 10%, and then 9%. This is my rate in percent. So I now have my interest. All you're going to do is multiply this by this all across board, right? So 15 million at 8% is giving me 1.2 million. So my calculator, this is 1.2. Of course, 10% of 10 million is a million. Then 9% of 5 million is 450,000. So when you sum 1.2, 1,450,000, that should be 2650. Then you come and find the total of your principal to 15 plus 10 is 25 plus 5 is 30. So this is 30 million. To find your weighted average capitalization rate, right? The WACR, weighted average capitalization rate. Okay. That's what this means. WACR. So that is essentially your interest over your principal times 100. Simple. That's it. So what did we get for our interest? For our interest, we got, one sec. Let me pick this pen. We got 2650. Principal, 30 million. So this is going to be 2650 divided by 30 multiplied by 100. Let me punch that, 2650 over 30. I'm getting 8.8333 recurring threes. So because of rounding, we can do 8.8333%. We can leave it at 4 decimals, right? 8.8333. The threes are recurring. So this is what we are going to use here. So we have found for requirement A, which is the weighted average capitalization. We are done. Requirement B is the total borrowing cost eligible for capitalization. Don't forget that for the project, it's financed partly by a specific loan and partly by some portion of the general borrowing. So we're going to do but we need to assess the timeline to know the capitalization period. Let's go and do a little analysis here. So requirement B, I'm going to look at the borrowing cost eligible for capitalization. Borrowing costs eligible for capitalization. Okay, so let's look at the capitalization period first. So the first step is to find my capitalization period. So let's start with the first one, which is active construction. Question told us here that construction start. Let me clean some of these. Construction started 1st February and it proceeded as planned until November. So from 1st November, there was a suspension. That means 1st February to 31st October, there was construction which was uninterrupted. Okay. So active construction, I'm going to put here, let me come here. I'm going to put here 1st February to 31st October. This, if you count, should be 9 months, right? Yep. So this is 9 months. Right. Okay. So for this period, we are going to capitalize. So put here capitalize. Okay. Then they had the environmental review. If you recall, we're told that the first 2 weeks, that is 1st to 14th November, was lost due to a scheduled environmental impact review. It was required by law. This was a necessary one. So we are not going to suspend capitalization. We'll still capitalize, right? So this was from 1st November to 14th November. This is approximately half a month. So we just say 0.5 months. This will still capitalize. Okay. Then the other one was a strike action. Okay. The strike was abnormal. It's an abnormal activity. So for that, you suspend capitalization. From the question, that was from 15th November to 30th November, which is also half a month. So if you check, they said, where are you? Yep. The final 2 weeks, 15 to 30 November, were lost due to an unexpected strike. Yeah. So here we're going to say, this guy, you are going to suspend, not capitalize. So I could highlight this. We'll suspend capitalization. And the final month, they said they resumed work on 1st December and the assets remained incomplete at the end. So it means they did till year end with no interruption. So that is going to be, we'll say, resume construction. That will be from 1st December to 31st December. That's a full month. So this 1 month. This will capitalize. So what that effectively means is that if we are looking at the capitalization period, it is everything except the 0.5 months we are suspending due to the strike action. So it's 9 plus 1, which is 10, plus 0.5, which is 10.5. So we have 10.5 months for capitalization purposes. Take note of this, right? So we found the capitalization period. Let's now go and look at the specific borrowing calculation. Then we'll go and do the general one. And then that's, so let's now look at for the specific borrowing. Specific borrowing cost. So if you check, we went for a loan of 20 million here. to assist with construction. I remember they said anytime money was not being used, we went to invest it and we earned 4% on that. So let's find the gross interest for the capitalization period, which is 10.5 months. So if you check the question, we actually spent 24 million, meaning that we would have spent what? The full 20 million. Do not forget that as for the bank, once you go for a loan and you start construction, they will charge you interest. Okay. They will charge you interest. But remember that we are going to take out the investment period. So here, let's do it this way. So for our specific loan, we have our gross specific interest, which is an amount of 20 million. Okay. At a rate of 6% for 10.5 months out of 12. Right. If you do this, 20 times 0.06 times 10.5 over 12, that gives me 1050. So that is my gross interest. But we're told that they did some investment. All right. There was some investment they did. So we would say, all right, let's go and find out how much would be invested. So we are going to less investment income. Question said surplus funds are what? Invested. So let's go and check. They got the loan on 1st February. They received 20 million. They spent 8. So if you receive 20 million and you spend an amount of 8 million, you have surplus of 12 million, which can be invested. That surplus will be invested until it is needed to be used on 1st September. So if we count our fingers, it means that you would have the money February, March, April, May, June, July, August, end of August. That's 7 months, right? And that's it. So we can say investment of the surplus funds. We'll say, okay, our surplus funds will be the total of 20 million minus the 8 million, which they spent in February, giving us an amount of 12 million Ghana cedis to be invested. The next time we needed the money was 1st September, meaning from February to August. The money was not used, so we had to what? Go and invest it. So we would say our investment period is going to be February to August. So we are going to invest an amount of 12 million at a rate of 4%. Where am I getting the 4%? The 4% is the idle funds rate. All right. And then I'll multiply this by the prorated 7/12. So if you do the math, 12 million by 0.04 by 7/12, 280,000. So this is how much we made from the investment. But if you watch this carefully, this is how much has been invested. Okay. Now, let's find the net specific borrowing cost. This will basically be our gross, which is this guy here, of 1050 minus the income from the temporary investment of 280. If I do this, so 1050 minus 280, I'm getting 770,000. This is it. Now, we have found the net specific borrowing, but be careful. The suspension was in November, right? The suspension of the activity was in November. So our activity does not affect it. And if you check here too, we started 1st February. We spent second tranche on 1st September. But remember, I said the 1st September spend will not be capable of being funded fully from your general borrowings, right? So that is how we are going to deal with the specific borrowing part. Let's go and look at the general borrowings part of things, and then I'll show you how much we would need to pick from. So this is a specific borrowing cost. Let's go to our general borrowing. So general borrowing cost. So for our general borrowing cost, let's ask ourselves one question. We went for 20 million, okay? So let's find the cumulative expenditure as at 1st September. So my cumulative expenditure at 1st September. At 1st September, I had spent 8 plus 16, which is 24 million, right? So 8 million plus 16 million, giving us 24 million, okay? Ghana cedi. Then what was my specific borrowing? So specific funds available. We went for a loan of 20 million, as we have all seen by now. So we will take out that 20 million. This implies that I would need to go and borrow 4 million, you see, from my general borrowing. So this is my excess to be funded by general borrowing. So excess funded by my general borrowings. Okay. So we are going to ask ourselves, when did we need that excess? Well, to be fair, the second payment was made from 1st September. So it means from 1st September till 31st December is when we have to what? Do the capitalization on the borrowing cost. Okay. So what is the effective period? September, October, November, December is 4 months. So September to December, both months inclusive, will be 4 months. But don't forget that there was some gap, you see, for half a month where we suspended capitalization. So we are going to subtract those 2 weeks, so minus the 0.5 months where there was a strike action, meaning our actual capitalization period, effective period, is 3.5 months, so 3.5 months. So our borrowing cost will be, well, we want to draw down 4 million from the general pool. What interest rate will we use? This is where we go and pick the weighted average capitalization rate. This guy here, if you recall, 8.8333. So times 8 0.8333% multiplied by what? 3.5 months out of 12. The 8.8333 is an annual rate. So you're going to do 4 million by 0.08833 times 3.5 divided by 12. This is giving me 103. Ghana cedi 103,056. So this is my borrowing cost from the general. So let's find our total capitalized borrowing cost. It will be the borrowing cost from the specific and the general. So our net specific borrowing cost and then our general borrowing cost. For general borrowing cost, we just got it here. So we'll put that figure here. 103,056. Okay. For our specific, if you recall, where are you? There you are. We got 770. So we'll pick this guy here. Okay. And then bring that here. So if you add the 770 to the 103,056, you're going to get 873,056. So this is the borrowing cost to be capitalized. Then our final requirement. So we've done the B part. Our final requirement is to calculate the total carrying amount of the hydroelectric power plant as at year end. So it's going to be total cost incurred plus the total capitalized borrowing cost, right? Pretty much, unless you are told a particular cost is not an eligible cost. So that should be quite simple to do. Our C part is the carrying amount of the asset. So we would have the 1st February progress payment. We would have our 1st September progress payment. And then we would add our capitalized borrowing cost. So our first payment, if you recall, we paid 8 million and 16 million. So 8 million, 16 million. Capitalized borrowing cost, we just got the total to be 873,056. 873,056. If you sum everything up, I'm going to be 873 plus 24 million. That should give us 24 million and 873,056. So this is my total carrying amount. So that is about it for this question, right? It should be an easy topic to handle, to deal with, which is on IAS 23 borrowing cost. So if you found this helpful, you can share with your colleagues. You can like, share this video, subscribe to our channel, and would see you in the next video. All the best in your exam preparation, and bye-bye.